So a single drone strike thousands of miles away just, wiped out $500 million in digital assets in exactly 60 minutes.
Hmm.
Today, we are finding out why.
Yeah, and since you already know the foundational mechanics of Bitcoin, we're just diving straight into the actual plumbing of what happened here. I mean, we're unpacking the exact macro triggers behind this massive drop.
Right, and looking at how geopolitical friction is kind of forcing this huge evolution in both institutional finance and, well, network technology.
Exactly. Because if you're watching the markets right now, you might think the Middle East headlines are just background noise.
Like, same news, different day.
Right, but the strike on the UAE's Barakah nuclear plant wasn't just noise. It had immediate mechanical consequences for your portfolio.
It basically set off this unavoidable chain reaction.
It did. That strike pushed Brent crude oil up to $111 a barrel.
Wow, 111.
Yeah, and when energy input costs spike like that, inflation expectations rise.
Yeah.
Which instantly drove the U.S. 10-year Treasury yield up to 4.63%.
And here's where we need to connect the dots for zero-yield assets, like Bitcoin. When a massive hedge fund can get a guaranteed 4.6% return from the U.S. government risk-free.
They suddenly have zero incentive to hold highly volatile assets that don't pay a dividend. I mean, the math literally forces them to sell. Capital just gets sucked right out of the room.
Right, which is what drove Bitcoin down to $76,509. But the initial macro sell-off wasn't even what caused the $527 million wipeout.
Yeah, that was the microstructural carnage, the automated algorithmic liquidations.
It's like a trapdoor opening underneath the derivatives market. One overleveraged trader's forced sell-off drives the price down just enough to trigger the next trader's automatic sell-off.
Exactly. It creates this vicious, totally unstoppable chain reaction.
The geopolitical tension was just the spark that dropped the first trapdoor. It's like a dry forest mathematically incinerating over $500 million in long positions.
Right. But while everyday retail traders are getting caught in that trapdoor, legacy institutions are reacting completely differently. They're engineering products to capitalize on that exact volatility.
Yeah, what analysts are calling boomer candy.
Boomer candy, yeah.
I have to admit, that perfectly describes Goldman Sachs filing for their new Bitcoin Premium Income ETF. Instead of just buying and holding, they are essentially selling the rights to Bitcoin's future price spikes.
Right, to generate a steady cash income today. It's a highly pragmatic shift. They're artificially capping the upside to offer their clients downside protection and predictable fiat yield.
But this pragmatism isn't just a Wall Street phenomenon, is it? It's infiltrating the corporate maximalists, too. Strategy Inc., formerly Microstrategy, just signaled they might eventually sell some holdings.
Yeah, to satisfy credit rating agencies, which is wild.
Wait, hold on. Michael Saylor is willing to sell, even though they literally just bought another 24,869 Bitcoin?
That's what they admitted, breaking the maximalist never-sell rule.
But if Saylor is willing to sell to appease a credit agency, doesn't that fundamentally destroy the whole corporate treasury black hole theory? You know, the idea that this asset goes onto balance sheets and never comes out.
I mean, it certainly forces a total market recalibration. If the market knows a corporate treasury isn't completely illiquid, traders have to start pricing in that latent supply risk.
So it normalizes Bitcoin as just like standard corporate liquidity rather than some untouchable religious artifact.
Exactly. But this shift from speculation to real-world utility is happening even faster on the network's application layer, especially when you look at global trade.
Oh, you mean how sanctioned nations are bypassing the Western banking system?
Yeah. Look at Iran.
Mhm.
They just launched Hormuz Safe, a new maritime insurance platform. They are mandating that commercial vessels settling premiums do so entirely in stablecoins.
Wow, so they're projecting, what, $10 billion in sovereign revenue? Bypassing the SWIFT network entirely?
Yep, entirely.
That is sovereign financial weaponization happening in plain sight. It basically proves the plumbing works for massive state-level evasion.
It does. But contrast that dark utility with what is happening simultaneously in open-source AI. Have you looked into the new BY402 protocol?
I have, and it's a brilliant piece of engineering. It actually revives an old, dormant internet error code, HTTP 402, which literally stands for payment required.
Right. So what BY402 does is allows AI agents to autonomously negotiate and execute sub-cent USDC payments directly machine to machine.
It's like finally giving artificial intelligence its own frictionless digital wallet. If an AI needs to pull data from a premium server, it doesn't need to ask for a human's credit card.
Exactly. The AI gets quoted a price, evaluates the terms, and authorizes a gasless stablecoin microtransaction instantly
It just completes the commerce entirely on its own.
on its own. So when you step back and look at all these pieces together, a really clear picture emerges. The ecosystem is rapidly transitioning away from pure speculative leverage.
Yeah, it's becoming a highly pragmatic tool. I mean, it's being used for institutional yield generation, geopolitical evasion, and now autonomous AI commerce.
It's completely maturing.
Which leaves you with a pretty provocative thought to mull over. We started this deep dive by talking about a trapdoor liquidating retail leverage. But if hostile nation-states and autonomous AI agents become the primary transactional drivers for these decentralized ledgers,
If they're the ones thriving in this new mechanical reality.
right, then will traditional retail adoption even matter to the network's future valuation?